Hi, I'm Sherrie Grabot, the Chief Executive Officer of GuidedChoice, and this is The Financial Wanderer. Now, here are some things to kind of keep in mind during this tax season if they fit your situation. And of course, everybody's different, and our tax regulations tend to be fairly complex. So you may need to utilize either an expert or a software package to help you get through this tax season. The first one, I think that generally speaking gets overlooked, is the issue of the state income tax refund. Let's say you got a state income tax refund last year for last year's taxes. Well, there is a line on Schedule A of the IRS Form 1040 that asks about a state income tax refund. But if you didn't itemize your deductions last year and you received that refund, you don't need to report it. It's not taxable income. So be aware, again, if you took the standard deduction, and that's most people will take the standard deduction, then you don't need to report that income. And that income is not taxable. Additionally, state tax paid for the previous year, if you did itemize and you owed taxes in the prior year and you paid those taxes, those are deductible. So you do want to include those. Now just remember, the state and local tax deduction is limited to $10,000 a year, $5,000 if you're married and filing separately. So there are limits, but you can deduct that. High income earners will probably have more than that $10,000 limit, and that is not deductible. Now, for those of you fortunate enough, like myself, to live in one of the 9 states that don't have an income tax, then you can look to the sales tax deduction. And you can deduct state sales taxes for any of those expenses that you've had. Now that can still apply even if you live in the other states that do have a state income tax. You just have to choose which one's best for you. There are times when it might be best to deduct your sales tax because you've had a purchase that's very large, let's say a car or a boat, and that tax is actually higher than your state income tax. If that's the case, then you would want to choose the sales tax deduction. So the IRS does provide a calculator on their website that would allow you to calculate both your sales tax as well as your state income tax, do a comparison, and see which is the better one for you to use on your deductions. Now just keep in mind, again, they've got that $10,000 limit in the $5,000 if you're married filing separately. Another area that gets oftentimes overlooked is the charitable contributions. And interestingly enough, I don't think any of us forget when we write a big check to a charity, but sometimes we forget the little things. It could be that you have a small payroll deduction coming out, going to United Way or some other charity, and maybe you forget about that. But what we want to make sure of is that we capture all of our charitable contributions. And that would include anything that you purchase, for example, for a charity. So say you work for the soup kitchen and you buy ingredients and you cook the soup, or maybe you just buy ingredients for the soup kitchen. That's all deductible. You buy stamps because you're sending out a mailer for a charity. That's deductible. The miles that you drive for a charity, that's deductible at 14 cents a mile. And that changes annually, so you would want to check to see what that mileage deduction would be. But don't forget those little things. The other types of contributions that oftentimes get overlooked, I would say, are the in-kind contributions. So those could be, for instance, if you're giving away a car or you're giving away some clothing. Those types of contributions are still deductible. Depends on what quality they're at. If they are not in a high level of quality, then they would not be deductible. I tend to take pictures of all of those types of items that I donate to make sure that they are in good quality, and then can take the deduction for them. So there's lots of different ways with charity that you can be receiving a deduction that oftentimes gets overlooked, and those little things do add up. Now another area is if you either bought a home or you refinanced a home, you may have paid points on your loan. And if you did, you get to deduct those points. Now the rules are somewhat complicated, so I won't go into all of them right now or you'll probably lose the attention, but you can deduct those, and generally speaking, they're done over time. And it may be over the 30-year period or the 15-year period of the loan. So you do need to check on those rules to see how much of those points you can deduct. But again, if you purchased a home and you took out a loan, or if you refinanced a home, check that benefit out, because that can be a significant benefit. Another one that might hit home for some of us is student loans. If the interest has been paid by a parent or a grandparent, actually, even as the student, you can still deduct that interest on your own account. In other words, what it looks like from the IRS is that it looks as though you received a gift and then you paid the student loan. So that interest that you paid, that is actually deductible for you, the student or the ex-student. So that's a little odd one that you'd want to keep track of if that's pertinent to you. And hey, if it's not, that's a great gift to ask for Christmas or your birthday. Rather than receiving things, maybe ask your parents or your grandparents or friends even to contribute to paying off your student loan. Another one is gambling losses. We know about that here in the state of Nevada. If you itemize deductions, and you have to itemize deductions in order to take this deduction, but that's a gambling loss. And the other thing to note is your gambling losses can only be deducted off of your gambling gains. So let's say I've got $200 in losses and only $100 in gains. I would only be able to deduct $100. So still, it's going to help because it would bring down my gambling income gains. So that would be for gambling. You'd want to make sure that you keep a diary. The IRS recommends that you keep a diary on where you were, what you were doing when you had your gains and your losses, who was with you at that time. So keep a daily diary, or as frequent as you do go out gambling, keep a diary with those details. Also keep in mind, if you're doing other things, I don't know, like playing the lottery, buying lottery tickets and that sort of thing, those do count. So you can add those up and count those as gambling losses or gains if you win. Another kind of, I don't know, somewhat unique tax deduction that you might be aware of or may not, if you were part of a jury this year, many employers continue to pay you even while you're doing your jury duty. But there's also this stipend that you receive when you're on jury duty. If your employer requires you to give them the stipend because they continue to pay you even while you're on jury duty, then make sure that you take the tax deduction for that. You don't want that included in your income because you've given that income to your employer. Now there's another thing to be aware of. This is not a tax deduction, but it can be very pertinent to any of you who have a brokerage account, so a retail account, not necessarily if it's in a 401k, but if you're in a brokerage account or some sort of retail account, or you own mutual funds. When you do, and you have dividends paid on those mutual funds, oftentimes they don't get paid out to you, they get reinvested back into the mutual fund, back into the account. If you reinvest dividends, then it's not really a tax deduction, but it is a subtraction that can save you a lot of money. That is because you don't have to pay taxes on those reinvested dividends. It's not until you take the money out that it would become taxable or part of your taxable gain. And it actually technically goes to your tax bases. So it actually would apply to your capital gains, which is a much lower tax rate than if you take it ongoing as income. So just be aware of that. That's a little unknown fact, I think, for a lot of investors. So you would want to be aware that you don't include that. If you're reinvesting those dividends, don't include that in your income, your earned income or unearned income, actually. And then the other thing to note would be tax credits. Tax credits are huge. Deductions are great because they reduce down your adjusted gross income, but a tax credit actually goes against the tax you owe. So in other words, if I owe $3,000 in tax, but I have a $100 tax credit, that means I only pay $2,900 in tax. Goes exactly against the tax that you owe. So these are huge. be aware of any tax credit that you may qualify for. The first one that might be the most common is child and dependent care tax credits. The dependent care can be very expensive for families. So just note that if you have those expenses, you can deduct them. You can deduct up to a certain amount. Usually it's $3,000 qualifying expenses for one child, a maximum of $6,000 if you have 2 or more children. So just be aware of that, because it can also help in the cost, not just of child care, but also if you have other dependents, say elderly parents that you're caring for. Another tax credit that's very pertinent to many people would be the dependent tax credit. So there's a $500 tax credit just for claiming a dependent on your return. So if you have children or dependents, you can claim that $500 tax credit. Make sure though that you are aware, if you're in the higher income brackets, you may not qualify for this tax credit. Typically that's more than $200,000 in annual income. If you're married, that goes up to $400,000. So just be aware you might not qualify for it if you're in the higher income brackets. Another huge tax credit issue is the earned income tax credit. Now, millions of low-income people already claim this credit, which is fabulous, but the IRS says 25% of low-income individuals don't claim this credit. And some of that is because we're not aware that we qualify for the credit. We might not think of ourselves as low income, we may be middle class, but this is becoming a more pertinent tax credit for more Americans. If you've lost your job, or you took a pay cut during the year, or maybe you worked fewer hours during the year, this could be pertinent to you. So make sure that you check out that earned income tax credit. Could be a very valuable benefit for you. The American Opportunity Credit is another way that government is trying to support higher education. So it's based on 100% of the first $2,000 of qualifying college expenses. And most of your college expenses are going to be qualifying. So again, just look at the IRS website and you can find out what those expenses are. But this is a significant benefit because it's 100% of your first $2,000 of expenses. It's 25% of the expenses after that, to a maximum of $2,500 per student. So make sure you look into that American Opportunity Credit, especially if you're a college student or you're doing your master's degree and you are also working. This would be a fabulous benefit for you. In addition to that, though, there's also the Lifetime Learning Credit. So Lifetime Learning Credit can be claimed for any number of years, and it's used to offset the cost of higher education for yourself or your spouse. So this is, again, for those who are working and are trying to improve their lot in life by getting higher education. So this is not just for your children, this is also for you. The credit, again, is worth $2,000 a year based on 20% up to $10,000 that you spend for any post-high school courses. And that's really just anything that's leading to new job skills or improved job skills. You would want to also check that out. It does have income levels where it's phased out. So if you're between $80,000 and $90,000 in income for an individual, it begins to get phased out. If you're married filing jointly, it's $160,000 to $180,000. So some of these tax credits, as you can see, go away the higher your income, but use as many of these benefits as you can. Now, if you're self-employed, obviously you're in a more complex situation very frequently with taxes. So some of the things that get overlooked, Social Security taxes that you pay while you are self-employed, you're going to pay the full 15.3% of Social Security and the Medicare tax for yourself instead of splitting it 50-50 with an employer. Make sure that you do deduct that full amount because that's a huge impact to your taxes. If you're self-employed and you're over 65 or over, and you qualify for Medicare, you can also deduct your Medicare as well as your supplement to Medicare expenses. So be sure to look into that. That's a huge benefit for seniors who are self-employed qualifying for Medicare. There's potentially a benefit there for you to deduct. Another significant kind of hidden benefit for retirees, The way our tax system goes, it's a pay-as-you-go system. So you are to pay 90% of your income taxes during the year while you're working. And at the end of the year, if you have a 10% differential, you're fine. But if you don't get that 90% paid into the system, you end up with a tax penalty at the end of the year. Now, if you're over 62 and you're retired, there is a way that you may be able to waive that penalty. And it's actually done through another form. It's not done on your taxes, so just be aware you'd have to use IRS Form 2210. And it would have to be because of reasonable cause. So for example, you're sick during the year, you didn't have the energy, time, effort, whatever, to be able to check into the 90% rule, or maybe you had a surprise expense or something came up. Anything that the IRS would deem reasonable cause, just check out that form. Again, huge benefit to not have to pay that penalty. Now, another category of individuals that have tax deductions that aren't available to everyone would be the military. So if you're in the military and you had moving expenses that were not covered by the military, typically the military will cover certain moving expenses, but they might not cover 100% of your expenses. If that move was deemed necessary by the military, you could still deduct moving expenses. That deduction's gone away for us civilians, but for the military, you would still have that available. If you're a military reservist, then your travel expenses may be deductible. So if you're in the military reserve, you're called up, you have to travel for military purposes, then just be aware you may have a benefit that you can deduct of those travel expenses that qualify. So today, that's a lot of information to take in, and obviously I probably haven't even covered all of the deductions that we could miss. These are just commonly missed deductions and tax credits. Please be aware that our tax laws are complicated. It's always best to go to a tax professional or use a software program that can walk you through all the benefits to make sure that you don't overpay on your taxes.